Hello and welcome to Pro Trader Strategies Market Commentary for December the 21st. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. All right, having that out of the way, let's get this on. Not a whole lot of data coming out this week. As a matter of fact, this should be a pretty quiet week. Just going into the holiday season, a lot of people are taking this week off and traveling, and usually this week is pretty quiet. Next week could pick up a little bit going into the year end and have a little bit more volatility. But having said that, let's get on to this. As you can see, the NASDAQ is up about 22 points, not anywhere close to regaining the losses that we saw on Friday. It did go up and test the value area high, but as you can tell, it's still stuck in here, and I could easily see it come down here, test this 200-day moving average, and which just coincidentally coincides with the value area or the point of control, which is where the most time and volume has been spent. This is another chart, E-mini S&Ps. As you can see here, is below the 200-day moving average and is below the point of control or the value area. We have come down but not quite tested the value area low here. So as this has gone below the 200-day moving average and is moving away, I would have to believe that the NASDAQ would at least go down and test that value area. All right, moving on to some trades that I let expire. I let 3 trades just kind of roll off because they were either at max loss or just weren't going to do anything, and just didn't want to keep that dream alive. And these, as with United States Steel Corporation X, I had on the December 9-10 put spread in there, and as you can tell, I have had this on for quite a while, and it just really never worked out. So there was not a whole lot I could do. It quickly went into a max loss, and it was just a cross your fingers and hope that there was a nice little rally at least, and that never came to fruition. So I just let that roll off as a max loss. The other trade that I let roll off as a max loss is this Hertz trade, and in Hertz I had on the December 15-16 put spread, and again, as soon as I put that trade on, it quickly moved into a max loss. It was very bad timing on that one. So that one I just let off, and you know, I don't have any directionality other than maybe it's more bearish now, but it's at such a cheap stock price now that it's almost not even worth trading it. GLD. On GLD I've had on for quite a while, and as a matter of fact, I was short some calls in I think they were the November or the October calls, and short the calls, the 113 calls, long the December 113 calls. Kind of did it as a calendar spread, thinking I could sell the short calls and finance my long calls and hopefully see this rally up. That didn't happen. Short calls did help fund those long calls, but the long calls I just let expire worthless. So that was a small loss there on the overall trade. Moving on to Netflix. This is a trade, the next trade that I did here in Netflix, I took off on Friday, and you could probably take it off a little bit better. I think last I checked it was about 20 cents better today to take off. But in Netflix, I had on the January 142.86 calls, and the reason why those are in a decimal point for those calls, that is kind of odd rather than a 50-cent increment, is because Netflix had that split. So that's caused those January calls to have that odd decimal point. Now as we go further out with like February and further, that is going to be negated. They're going to have rounded off numbers for the most part, maybe 2.5 $2.50 wide ticks, but going forward, that won't happen again unless they do another split down the road, which I don't foresee that happening anytime soon. But I originally sold these January 142.86 calls for $1.42, and I covered it back on Friday for 85 cents. I think the last I checked, like I said, it was around 60 cents. So you can do that one a little bit better. These are trades that I put on now today. Disney's gotten beat up. They got downgraded by a couple of people saying that Star Wars, unless it got $2 billion in global sales, that it wasn't going to meet their expectations. Well, they knocked it out of the park this weekend with their global sales. I think it was like 157 million, and that was a record breaker. Although it has gone below this 200-day moving average, it looks pretty bearish. This looks like an area that it's going to at least act as support. As you can see, it came down and tested it this morning and has bounced away, up and away from that. So I looked at this to be a support area and this to be another support area. So I kind of went further out, and that $100 area I think is going to act as a nice psychological barrier. So I did the February 99 100 put spread. So I bought the 99s, sold the 100 puts, and I collected $1.05 for that trade. So hopefully we can get a little bit of a rebound after some of the news starts coming out that Star Wars is a big hit. On to UNG. UNG seems to have found a bottom. I mean, natural gas is almost free, and I don't see it being free for very long. We also have some volatility start to contract here, so I wanted to get into this trade before I lost all the implied volatility in this trade, and I've been looking to get into it. So it looks like it's kind of found a bottom here and wants to bounce up. Hopefully we'll get up into this 10 area, which would not be unreasonable. I think it's just way oversold. I think the longs that have been trying to hold it up here just seem to have puked out. So I did the February and sold the 6 puts for 20 cents. Didn't collect a whole lot for that, but again, it is a $7 stock for the most part. So hopefully we can get a little bit of rally in there, and I'll just be able to take that off relatively quickly. That's about all I got for you guys today. Friday's webinar is going to be bumped up to Wednesday just because of the holiday. Nobody's going to be trading for the most part. So we're going to be doing this webinar on Wednesday, and we're building upon this idea that the NYSE is getting rid of stop orders. So we originally did one on buying puts to replace the stop. Then we built upon that with putting an order in where you're using a stop and a limit order to help finance that put, so you don't have to lay out as much money. Now we're going to build upon that strategy and use a short call spread to finance the put. That allows us to participate on the upside if the market continues to rally. It's not going to act really like a limit order like the naked call would, or the call would against our stock or covered call. We're going to be able to participate as soon as it goes above our defined risk area. So that call spread will help finance our put, and that's the main concern right now in a bearish market, that we'll see a pretty major drop or precipitous drop, and we'll be able to finance that put or make some decisions down the road with that. All right, so check out that on Wednesday for that webinar. All right, that's all I got for you guys today. If I don't see you or hear from you, have a great holiday season, and if you can't take that, take it easy.